Hello students, in this video we will properly revise and from a pure examination perspective business combination. Later we will also do consolidation and then internal reconstruction. So first we have business combination, then we have consolidated financial statements, and also we have something called as internal reconstruction. These two chapters account for 40% or 40 marks in your examination, and we see one 14 mark question from business combination and one 14 marks question from consolidated financial statements easily in almost every examination. Now these two chapters, if we are able to master, and trust me, after watching this video you will realize that these chapters are actually not very difficult chapters as it is perceived by the students. A lot of students have the fear of consolidation is difficult, business combination is difficult. I will tell you few steps, I will tell you few frameworks, then you will realize that these chapters are not at all difficult, and in fact you can easily pocket 14 plus 14 marks in the examination. Trust me, after watching this video you will also tell the same thing, that business combination is not very difficult. Of course it is tricky, of course there are some adjustments you need to be aware about, but very difficult? Not at all. We will make it easy. Alright. Now before I jump into what business combination is about and how does Ind AS 103 talk about it, before that I want to give you a framework from the point of view of the examination. Now whether you pick up a business combination question or a consolidated financial statement question, both go hand in hand. Okay, you cannot say I'll just read consolidation, both of them you have to study together. What happens is you typically get one balance sheet of a purchasing or acquiring company and another balance sheet of the selling company. So you have, let us say, a parent company and a subsidiary company. You have balance sheets, you have assets, you have liabilities and equity for both the companies. Okay. Now under assets, what do you have normally? Non-current assets, current assets, and then sometimes you may have investment in subsidiary, sometimes this accounting is yet to be done. Okay, especially in a consolidated financial statement question, investment in subsidiary is also given. On the liability and equity sides, you will have equity, share capital, you will have reserves, and then you will have your liabilities. Okay. Will this be a tallied balance sheet? Sir, what are you saying? Examination mein to we get tallied balance sheet only, no problem. Okay. Now parent has some amount of stake, or you can say voting power, sometimes we call it control over S. Parent has some stake in S. Depending on what is the stake level, we will have different types of accounting. Sir, what are those stake levels? You can have less than 20%, you can have greater than or equal to 20%, you can have more than 50%. Sometimes you can also have equal to 50%. Okay, that also I'll mention it out here. So you can have exactly equal to 50%, and then you can have more than 50%. These different scenarios are possible. If it is less than 20%, it is your normal investment, and which we account under Ind AS 109. Which method? You can follow either fair value through P&L method or fair value through other comprehensive income method. Okay. Then if it is greater than or equal to 20%, we presume that P has significant influence over S. So more than 20% makes it what? Significant influence. Significant influence. For significant influence, we have something called as equity method, which is prescribed by Ind AS 28. So if it is greater than or equal to 20%, we follow equity method, which is prescribed by Ind AS 28. That also we'll understand. If it is 50%, we say, sir, there is joint control. And for joint control also there are different types of accounting. There can be equity method, there can be proportionate consolidation, all of that is possible. That also we'll understand. And lastly, we have more than 50% where we say there is control. Okay, it is not necessary that you need to have more than 50% for control. At less than 50% also there can be control. You can have maximum number of directors because of which you have control. All of that is possible. But typically in an examination, you will have more than 50% stake which is held by parent in a subsidiary. And when there is control, two standards are triggered. You have Ind AS 103 and Ind AS 110. Separate financial statement 27 and all, we will talk about it later. Sir, what does Ind AS 103 tell and what does Ind AS 110 say? Control means one entity can direct the other entity. Whatever first entity says, the other entity has to listen. For example, you have, let us say, Reliance Industries Limited. They control Jio. Now, Reliance Industries Limited, whatever they decide, Jio has to follow. Jio can't say no. That is what is the meaning of control. Okay. Now, whenever we have control, there are two standards which are triggered. One is Ind AS 103 and Ind AS 110. 103 talks about initial accounting. That is also called as acquisition accounting. So, if you look at the title of Ind AS 103, Ind AS 103 title is business combination. Basically, when one business is combined or when one business combines with another business, or when one business or one entity acquires another business, one entity has control over another business or another entity, we apply business combination. Please remember, when you learnt accounting standard 14, there we used to say amalgamation of companies. Here we are saying business. So, sometimes it may be possible that one company is acquiring only a part of the business of another company. One company need not acquire another company fully. One company may acquire just business of another company. Even that falls under Ind AS 103. So, 103 tells us initially how should you account for it. Initially, at the time of acquisition, how should you account for it. So, then what does Ind AS 110 says? After initial acquisition, two scenarios are possible. Okay. After acquisition, two scenarios are possible. Say for example, Reliance Industries Limited acquired Jio. Actually, they had acquired, huh? It was a separate company. Okay. Now, when Reliance Industries acquired Jio, two scenarios are possible. First scenario, all the assets and liabilities of Jio are acquired by Reliance Industries and Jio no longer exists. Okay. One scenario is Reliance has acquired Jio, Jio no longer exists. Some more examples if you have to understand. Vodafone and Idea merged together. They formed a new entity, Vodafone Idea. Vodafone does not exist anymore. Idea also does not exist anymore. Okay. In such scenario where the selling companies do not exist anymore, then you don't need to apply Ind AS 110. Ind AS 110 is not applicable. You will do initial acquisition accounting as per Ind AS 103. After that, you will prepare normal financial statements and you will be done with it. But when Reliance has acquired Jio, or let us say when Reliance Group has acquired Jio Hotstar, whatever it is Jio existing as a separate entity today? Yes. So, if selling company exists, then subsequently Ind AS 110 is applicable for preparation of consolidated financial statement. So, under Ind AS 110, every year at the year end, when we prepare consolidated financial statements, those principles are given by Ind AS 110. So, Ind AS 103 is the starting point. When one company acquires a business, we follow the principles of Ind AS 103, and subsequently at every year end, we follow the principles of Ind AS 110 for preparation of consolidated financial statements. 103 talks about first part, 110 talks about continuation part. But in the examination, if you have to attempt 110 question, you need to have the knowledge of Ind AS 103 as well. Okay. I hope this framework is clear. Now, coming back to our balance sheet. Now, as I told you, in any examination question, you will have the balance sheet of parent and subsidiary. These will be tallied balance sheet. And our objective will be to combine both of these balance sheets. One tallied balance sheet with another tallied balance sheet, if I have to combine, it will of course tally. But sir, it is not so easy. I also understand there are some adjustments that we need to take care of. And one thing about adjustment is all the adjustments will have two-side effect. All the adjustments will have two-side effect, and when all the adjustments has two-side effect, automatically when you give both the effect, it will automatically tally. Tallying of balance sheet should not be a problem. But sir, what about adjustments? I will explain the logic and I will tell you how to remember each of those adjustments so that you will never forget, not only in the exam but in life as well. Alright. So if you have to see the balance sheet, we have non-current asset. So I am putting some random numbers, let us say 1000. Then you have investment in subsidiary. Okay, investment in subsidiary. Let us assume they have accounted for investment in subsidiary. Subsequently, we will see what happens when it is not accounted. So let us say investment in subsidiary is 800, current assets is 500. So what is the total? 2300. Subsidiary has non-current assets 600, they don't have any investment, and they have 400 here, this is 1000. Equity share capital of the first company is, let us say, no, 1000 and 1000 again will be confusing. So let us put some other number. Here it is 800 and here it is, and in the subsidiary it is 400. Okay. Then reserves, here we have, let us say, 1000, and here we have 500 as liability. In case of subsidiary, liability is 300 and reserves we have 300. Okay. So if you see 1000, here also it is 1000 and here also it is 2300. Now we can add as many number of items as we want in each of these category. Now the objective when we are preparing consolidated financial statement is that when one company P controls another company S, we say that this is a group of companies like a family, parent, child. Okay. So parent prepares its standalone financial statement separately. Subsidiary also prepares standalone financials separately. But to the outsiders, they want to see as a family, as a group, what is the performance. That is why we prepare consolidated financial statements. Okay. So when we have parent and subsidiary, we are not looking at parent independently. We are looking at what all parent controls. What is the net worth of that? What is the business of that? What is the profit of that? What are the assets? What are the liabilities? All put together, we look it as a family. So if you look at performance of an individual, it is standalone financial statement. But if you look at performance of the family, parent and the child all put together, what is the total performance? Then it is consolidated financial statement. So what we are expected to do in examination, you are expected to do P plus S, parent plus subsidiary, you have to prepare the consolidated financial statement. Alright. Now, how do we do the consolidation? Okay. Now, if you see, there is investment in subsidiary 800. Now, assume this is for 70% stake in the subsidiary. Now, what is the meaning of 70%? We are saying that whatever is the net worth of the subsidiary, in that we have 70%. And just for clarity, this balance sheet that I am discussing is on the date of acquisition. Okay, so that you don't get confused. So, what I am saying, out of this 700, we have 70% stake. So today if the company closes down, we get 70% of the net assets of the subsidiary. Okay. Sir, what about 30%? So out of this 70% is belonging to parent, 30% belongs to something called as non-controlling interest. 70% gives us control. We have controlling interest. The other party which holds 30% in S, they don't have control. That is called non-controlling interest. Controlling interest, non-controlling interest. Alright. Now, we paid 800. We paid 800 and we get 70% in this. So, how much is 70% in this? 400 plus 300, this is 700. 70% in this is 490. 70% in that is how much? 490. Balance 30% of 700, 210 belongs to NCI. Now for 490, we paid 800. We invested 800 to get a share in the net asset of 490. So why did we pay extra? We generally pay extra towards goodwill. That is one. Second, these assets may have higher value. That is also one possibility. Now those higher value adjustments and all of that, I'll come to it later. Right now I want to tell you the structure that you should follow when you are preparing consolidated balance sheet. Alright. So with 800 we get 70% of 700, which is 490. Assume all of these are fair value of the business only. Alright. And 30% goes to NCI. Why did we pay extra? We paid extra because maybe there is some goodwill value or there are some other assets which have higher value. For now, we will assume the extra amount paid is towards goodwill only. Okay. So what happens is, if you look at owners of S, who are the owners? P is the owner and NCI is the owner. Okay. How much did P pay? P paid 800. Owner paid 800. What is the value of NCI? NCI has a valuation of 210. So total owner side becomes 1010. What is the net asset of the business? See, net asset can be computed as assets minus liabilities, that is 1000 minus 300 or 400 plus 300. Either ways we can do it. Alright. So net asset is how much? 700. Now think of it. The owners have put in 800 plus 210, but sir, NCI did not pay any money. Had NCI paid something, I am saying they would have paid 210 and net asset is 700. So we paid, owners paid 1010 for assets worth 700. The difference of 310 is what we say is goodwill. The other way to look at it is 700 is the net asset. We have to give 210 to the non-controlling interest. So they are left with 490. We paid 800 to get 490. So we paid 800 to get net assets of 490, means this extra amount of 310 is goodwill. Okay. Once we do a couple of questions, calculation of goodwill will become easier for you. So first step is identifying how much is the goodwill. That is what we have done here. We will see what has the owners paid, how much is NCI and what are the net asset. The balance amount is goodwill. Now please remember, there are some fair value adjustments etc. which we need to do, that I will cover it up as we proceed further, not right now. Okay. Now this is what we have done. Now this is what we have done. Now when we have to prepare a combined balance sheet, okay, this investment of 800 is represented by the net assets here. So if I show on the investment side and on the equity and liabilities side, it becomes double counting. So it's like father has invested 1000 rupees in the business of the son. Now to the outsiders, when they look at the family, the money is still inside the family, money has not gone out. So we have to eliminate these things. So when we prepare consolidated balance sheet, what we do is we simply add up assets 1000 plus 600, we add up, it becomes 1600. This investment of 800 is eliminated against this 700. So this 700 is removed and this 800 is removed. Now when I remove this 700, parent portion 490, NCA portion is 210. That is one thing. Second, I have 800 here, but I am eliminating 490 only. So the balance 310 comes as goodwill. Alright, then current asset 500 plus 400, 900. So 16 plus 3, 19 plus 9, 28, 2810. Come to the equity and liability side. This 400 we have removed, this 300 also we have removed. We have only parents 800. So here we will say 800, which belongs to the parent. Reserves of 1000, as it is we will take of the parent. Subsidiary is getting eliminated. Liability 500 plus 300, 800. And out of these 700, 210 belongs to NCI, that also we will show. So what happened? 800 plus 800, 1600, 2600, 2810. How much ever complex a consolidation question is or a business combination question is, this is how you will have to do. Okay. This is a basic framework. Take assets of parent and subsidiary, combine all of them, eliminate investment with the equity share capital and reserves, and then prepare the consolidated balance sheet. This is the base framework. Okay. Now, because we are very careful of double adjustment, means one thing where you have adjusted, you have to ensure that the next place also you have adjusted it properly, your balance sheet will always tally, there will never be a problem. Okay. Now having understood this framework and this background, let us start one by one various aspects that we need to know when we are preparing consolidated financial statement. Again, because it's a revision video, I will not be going into too much of depth. Alright. So let's start. So as I told you, there will be one entity which is a parent entity and there is a second entity which is a subsidiary entity. Control or voting or stake can be anywhere more than 50% up to 100%. Okay, that is possible. Alright. Now, whenever P acquires S, some controlling stake in S, there are two ways to do. One, they acquire the assets and liabilities, that is one option. Most of the cases, the question that you will get is, they have acquired percentage stake in S, means the example that we saw here, 800 that they have acquired, basically they are saying 70% of the equity share capital, alright. And when one company acquires stake in another company, will it happen for free? No. You have to pay something to the owners of S, correct? We have to pay something to the owners of S. So S will have their own owners, P will pay something to the owners of S. Sir, what else? What all things can be paid? Number one is cash. Cash means not literally cash, it can be through bank also. So whatever cash is paid to the owners of S, that we say is a part of something called as purchase consideration. Ultimately, what is P doing? P is buying a business. When P is buying a business or P is buying a stake in another business, they will pay something to the owners. Whatever is paid is called purchase consideration. Purchase consideration first includes cash, the most common way of acquisition. Second, P can issue equity of P. P can issue equity of P. Fair value of equity is included in purchase consideration. First, you can pay cash. Second, you can issue equity. Third, you can issue debentures or any other liability. Sir, how can debentures being paid? Sir, how can debentures be included in purchase consideration? Whatever is given to the owners is a part of purchase consideration. If I give equity shares to the debenture holders, that is not purchase consideration. But if I gave debentures to the equity holders, that is a purchase consideration. So, whenever the debentures are issued or any other liabilities, please remember, to the owners of S, that is a part of purchase consideration. This also will be recorded at fair value. Apart from this, P can transfer other assets like maybe building, any other investment or any other asset. Even this has to be recorded at fair value. So let's say I have a building. Building has a book value of 1000, fair value of 1500. So this 1500 will be considered as purchase consideration. So whatever change between 1000 and 1500, that 500 will be recorded as a gain. Okay. So you can give other assets also. Then there can be something called as deferred consideration. What is deferred consideration? I will pay some amount after 1 year, 2 years, 3 years. So P will say, I will pay 1 lakh after 3 years. Now if you pay 1 lakh after 3 years, how will I record it today? In Ind AS, we always record it at fair value. In this case, fair value is present value of 1 lakh. In this case, fair value is present value of 1 lakh. So this deferred consideration will be recorded at present value. Then there is something called as contingent consideration. Sir, what is contingent consideration? We will pay you some amount if some conditions are satisfied. Because see, when P acquires S, P will have a lot of doubt on performance of S. Correct or not? So P will say, I will pay some amount if profitability is more than 20%, if growth in sales is more than 20%, some or the other condition. So there can be contingent consideration which is payable. See, we may pay, we may not pay depending on the satisfaction of the contingency, but P has agreed that they will pay contingent consideration. In such a case, these contingent consideration are also recorded at fair value. Say for example, 1 lakh is payable after 3 years. But given today's scenario, P assumes that, or P estimates that maximum fair value, probability based fair value, if you have to compute, it is only 30,000. So in that case, you will take fair value only. Okay. So contingent consideration is also a part of purchase consideration. Sir, what is the meaning of all of this purchase consideration? If you remember, I said no, there is investment in S. This is what represents investment in S. Come on everyone. So what all is included? Cash transferred, asset transferred, equity issued, debentures issued, liability issued. All of that is a part of purchase consideration. Anything payable later, after 1 year, after 2 years, after 3 years, that is also purchase consideration, will be recorded at fair value. Then contingent consideration, may pay, may not pay, but again we will estimate the fair value and we will record it. Okay. This is called purchase consideration, what the parent company will be paying or transferring to the owners of the subsidiary company. Alright, this is the first thing. So this calculation of purchase consideration based on the information given in the question is our first step. We will see how much has the parent entity paid or transferred or will pay to the owners of the subsidiary to acquire the business. That is called purchase consideration. That is the first calculation. Then the second calculation that we do is something called as fair value of net assets acquired. Sir, what is this fair value of net assets acquired? Coming back to our previous example here, we said, here what did we say? When we invest some amount in S, we have some claim on the net asset of the entity. The net asset can be computed as either asset minus liability or equity plus reserves. So, why am I paying this purchase consideration? Why am I paying this purchase consideration? I am acquiring control over the net assets of the subsidiary. Net assets can be all the assets minus liabilities, or it can be equity plus reserves on date of acquisition. Now please remember, we are using the term fair value. In the subsidiary's balance sheet, everything will be at book value only. Nothing will be at fair value. We have to determine the fair value. We have to determine the fair value. So what we will take? We will take fair value of assets minus fair value of liability. We will get fair value of net asset. But if we do equity plus reserves, we will only get book value. So when we are following equity plus reserves, and we will understand this in some questions, we will have to do any fair value related adjustment. So on one side we are saying, what is the fair value of consideration transferred? What did you pay? And on the second side we are saying, what did you acquire? We acquired net asset. But sir, this net asset represents 100%. We may not have acquired 100%. Agreed. Then the third thing you have to do, out of this 100%, what goes to NCI? Maybe we have acquired 80%. NCI says we need 20%. Correct? So let us say the net asset comes to 1000. NCI will say 200 belongs to us. NCI says 200 belongs to us. Okay. Now for the calculation of NCI, we have two methods. One is called proportionate share in net asset. Means whatever is the net asset fair value you have computed here, in that what is the share of NCI? What is the share of NCI? 20% of 1200. Okay. Now one more thing, please understand, in this net asset we take only identifiable net asset. What are the net assets you can identify? Only that you will take. The assets that you cannot identify, you will not take. For example, goodwill. Goodwill is not an identifiable asset as per Ind AS 38. So that goodwill we will not take. So when we are saying NCI, share in net asset, we are computing only in the identifiable net asset. But sometimes companies may feel that this is not a correct presentation because NCI also has a claim over goodwill. So in that case, the second option is something called as fair value of NCI. We directly compute the fair value of NCI. Now for the computation purpose, either they may give in the question specifically, or we may have to compute based on parent stake. So for example, if parent paid some amount to acquire 80%, how much should be 20%? That is one way. Or the question will specifically say this is the fair value of NCI. Or the question will give you number of shares into market rate. So like this also you can compute the fair value. Now please remember, when I using fair value of NCI, here I am including goodwill attributable to NCI as well. This is just for your information. So one is proportionate share in net asset method. Second one is fair value of NCI or fair value method. Okay. Now, there is on one side fair value of net asset. On the other side, you have owners. Okay. In owner, one owner is P. P has 80%. And on the other side, you have someone called as NCI. Okay. Out of this net asset, if parent says I have 80% stake, the other way to look at it is there are fair value of net asset, the business have some net asset, the business has some net asset. Out of that I have to pay something to NCI. So fair value minus NCI, whatever is there, fair value minus NCI, that belongs to the owners, or that belongs to the fair value minus NCI, whatever is the balance belongs to the parent. Correct or not? So out of whatever net asset the business has, if I settle the NCI, whatever is left over is attributable to parent. The other way to look at it is there is a fair value of net asset. On this we have claim of P and we have claim of NCI. So after whatever I pay to NCI, let us say I have to pay 200 to NCI, fair value of net asset is 1100. Okay. And 1100 minus 200 if I do, I get how much? I get 900. Let us say I paid 1000 to the sellers. I am again revisiting the example for more clarity for you. Parent paid 1000 to acquire 80% stake in NCI, and NCI is parent paid 1000 to acquire 80% in subsidiary. How much? 80% in subsidiary. Okay. Subsidiary has total assets of 1100 at fair value, not at book value, at fair value 1100. And NCI is valued at 200, means out of 1100, 200 we have to give to NCI. Means how much is left for us? For us we have only 900. For that 900 we paid how much? 1000. So that 1000 minus 900, 100 is called goodwill. But in the examination you have to calculate this as purchase consideration by parent plus NCI. How much is the total? 1200. Fair value of net asset, how much is the total? 1100. Net amount that is left is 100, which is goodwill. So in exams what you will do? Number 1, purchase consideration at fair value. Number 2, NCI at proportionate share in net asset or fair value total. On the other side you will have net assets of whom? Of subsidiary, fair value. Okay. If owner side, this I call to be the owner side and this I call to be the asset side. If owner side is more, then we have something called as goodwill. If owner side is less, then we have something called as bargain purchase or capital reserve. Okay. So step by step can we calculate? First, from the question in the examination, you will take how to determine purchase consideration. It will be given to you in the question. Now after this, we will take some questions so that you will have more clarity on how to compute those things. Okay. Then second, NCI. NCI will calculate either as a percentage of net assets or fair value. Net asset will take fair value of assets minus fair value of liabilities, or equity plus liabilities subject to fair value adjustments. Okay. Then how do we calculate goodwill? We will take the purchase consideration plus NCI and compare it with net asset. If the purchase consideration plus NCI is greater than the net asset, then there is goodwill, otherwise there is capital reserve. So far all clear? No problem? Okay. Now, Ind AS 103 talks about acquisition date accounting. Now how do you do this acquisition date accounting? Please remember, we prepared consolidated balance sheet of parent plus subsidiary. Okay. Now what parent has to do is, what all it controls, it has to show it in the balance sheet. Remember, let's say PP definition, PP is an asset which is controlled by the entity. Here also parent controls the subsidiary. Indirectly, parent controls net asset of the subsidiary. Because parent controls net asset of the subsidiary, parent will incorporate all the assets and liabilities of the subsidiary. So what we will do, we will incorporate all the assets of S debit at fair value to all the liabilities of S at fair value. All the assets, all the liabilities. Can I say net asset? Yes, you can say net asset. Why are we incorporating this? Because now we have control over the net asset. That's why we are incorporating it. Now to acquire this, what did we pay? Sir, we paid purchase consideration to purchase consideration. Now don't write to PC. This purchase consideration can be to cash, it can be to equity shares, it can be to debentures, it can be to it can be through deferred consideration, it can be through any of these. So to purchase consideration. Okay. Then we acquired assets, we assumed the liabilities, we paid the purchase consideration. Okay. Now if you come back to the consolidated balance sheet, two things appeared extra. One is goodwill on acquisition, which is not identifiable, and NCI. So what we have to do, we have to recognize to NCI, that is the non-controlling interest, either at fair value or proportionate share basis, and the balancing figure will be goodwill or capital reserve. Okay, or capital reserve, the balancing amount. Now please remember, when we are saying assets of S and liabilities of S, both of these have to be identifiable. If you cannot identify something, then that will be assumed to be a part of the goodwill. Okay. So the initial entry, debit all assets of subsidiary, credit all liabilities, credit the purchase consideration, credit NCI, and debit goodwill or credit capital reserve, as the case may be. Alright. So that is the acquisition date accounting. Now this acquisition date accounting also holds good when you acquire a business and you have to account it in the separate financial statement. Alright. Passing of journal entries has been tested quite a few times in the examination, so you should get used to how to pass the entries. Assets, fair value. Liabilities, fair value. NCI, proportionate share or fair value. Then goodwill or capital reserve. Now using this framework, let us see how to pass the entry in the same example that you have taken here. Okay. See, I am using a very simple example to make you comfortable. Gradually we will pick up questions from the material and you will be in a better position to do. Okay. So what we should take? We should take over the asset 600 plus 400 and the liabilities 300. So what you will do? You will say non-current assets debit, current assets debit to liabilities. So it was how much? 600, 400 and 300. 600, 400 and 300. How much did NCI come to? To NCI 210, this number. Alright. Then what did we pay? Here we have already accounted for this investment entry. Investment in S 800. So because we have already accounted for it, we can say to investment in S. Otherwise, you will write to cash and whatever is the consideration. How much is that? 800. So 800 plus 300, 1100, 1100 plus 210, 1310, 1310 minus 1000. The balancing figure comes to goodwill, which is how much? 310. Basically, we are adding all of these in the consolidated balance sheet. Alright. Now, goodwill, please remember, cannot be amortized. Even if the question tells you useful life is this much, that much and all of that, it cannot be amortized. See, in accounting standards, we can amortize it, but here it cannot be amortized. It will be tested for impairment annually under Ind AS 36. So, goodwill cannot be amortized. Alright. Now, this was a case where we recorded all the items at book values only and we assume book value is the fair value. Now, let us assume that fair value of non-current asset is 1100. Fair value of non-current asset, not 1100. Fair value of non-current asset is, let us say, 700. Can we assume that? Yes, we can assume what is there. Okay. And we are following NCI also at fair value, and fair value of NCI is 250. If this is the scenario, how will we recompute it? Again, fair value of non-current asset is how much? 700. So, first step, purchase consideration. Has it changed? No, it is 800. Second step, net asset at fair value. Okay, so for net asset at fair value, non-current asset is equal to 700, current asset is equal to 400, liabilities is equal to 300. So 11 minus 3, 1200 is the fair value of net asset. Fair value of net asset 1200. Alright, clear? Okay. Now this 1200 can also be calculated as equity, share capital and reserves. How much is there in our original thing? 400 plus 300, 700. I made a mistake here. 7 plus 4, 11, 11 minus 3 is 800. Equity share capital is 400, reserves is 300. How much is the total? 700. This is book value. Now, fair value of non-current asset we said is 700. What was the book value? Book value is 600. Means what is the increase in fair value? Plus fair value increase 100 of non-current asset. So 700 plus 100, 800. You can do it that way also, you can do it this way also. Take individual asset or take equity, share capital and reserves and surplus. This we will largely follow in consolidated financial statements. Okay, done? Right. Then third, goodwill or capital reserve. For goodwill or capital reserve, you will take, what is the purchase consideration? 800. What is the NCI fair value? 250. Correct? Okay. Total is how much? 1050. Then this is first. Second, fair value of net asset is how much? 800. So what is the goodwill? Goodwill is 250. Now did you observe one thing? The moment fair value of any asset increased, the value of goodwill reduced. The NCI became 250 and here the increase, and in net asset the increase was 100. Okay, so net if you see, here it was how much? Here it was 210, right? So net if you see, asset increased by 100, NCI increased by, NCI increased by 40. So net impact is how much? 60. By 60 the goodwill value has come down. Okay, so if more and more identifiable assets are there, the value of goodwill will definitely come down, right? This is how we will do the calculation. This is the basic introduction for your revision purpose. Now what we will do is, we will look at some of the initial acquisition questions and then we will move on to the specific adjustments and other items. Now before moving further, a quick recap and some important points that we need to take care before solving questions. Okay, first, whenever we apply Ind AS 103 is applied when there is a business combination, right? And in case of business combination, one entity which we call it to be a parent entity has control over what? Over a subsidiary. Now whenever you get a question in the examination, two things are very important. First, we need to identify the acquirer. Now who is the acquirer? Acquirer is the entity that gets control. Now generally the purchasing company acquires control over the selling company, but in some cases the selling company may have the control, or the shareholders of the selling company, I would say, has the control over the combined entity. That we will understand when we discuss reverse acquisition. And sometimes there is a situation called as common control transaction, that also we will understand later. But in consolidation questions or in business combination questions, first thing what we need to do, who is the acquirer? And second most important thing, when is the acquisition happening? What is the acquisition date? Now here, let us say initially on 1st of January we have 15% stake, and on 30th of June we got another 40% stake. So here 15%, here 40%. Now when 15% is acquired, control is not acquired. But when subsequently 40% when we acquire, what is the total stake? Total stake is 55%. Now that is when the control has passed on. So for us the acquisition date is 30th of June. Now why is this date important? This date is important because this is the date on which we will recognize or will compute the fair value of assets and liabilities. NCI is also computed on that date. Okay. Now fair value for assets liabilities, NCI can also be on proportionate share in net asset basis. And on this date we will calculate goodwill or bargain purchase. So this is one thing we have to keep in mind. First thing, identifying the acquirer. Now if two entities are combining together, we have to identify which entity effectively retains control over the combined entity. That is what we need to understand. Okay. Usually the company that transfers cash, other assets and incurs liability, basically the purchasing company is the acquirer, but in some situation the selling company may also be the acquirer. Okay, so this we'll understand in reverse acquisition. Acquisition date on which the control has been obtained. Then the most important thing, on the date of acquisition the acquirer recognizes identifiable assets, liabilities and any NCI on the date of acquisition separately from goodwill. So all the identifiable assets, all the identifiable liabilities are recognized. NCI is also recognized. There are two methods to recognize NCI. Apart from that, something which is not identifiable, we recognize it as goodwill. As I told you, if the business has assets of, let us say, 10, identifiable net asset have fair value of 10, we paid 11. Why did we pay that one extra? We cannot identify. So that one extra that we have paid is goodwill. Alright. Then coming to measurement of non-controlling interest, there can be non-controlling interest at fair value or proportionate share in net asset basis. Previously I have given you a small example. As we do more and more questions, you will be clear about that. Alright. Then some special items that we need to be aware of. We said we will recognize fair value of identifiable net asset, which is asset minus liability. Now sometimes the selling company or the transferor company or the acquiree may have contingent liabilities. Now tell me one thing, do we recognize contingent liability in our books as per Ind AS 37? We do not. But when we are acquiring a business under Ind AS 103, we will recognize fair value of the contingent liability as a separate identifiable liability. Sir, what is the reason? A very simple example, let us say there is a home which you want to buy or a house that you want to buy. The price is 1 crore. Price is 1 crore. Suddenly you realize that there is a court case going on. Now tell me, will you still pay 1 crore to acquire the home? You will not pay, right? Why? Because there is a risk that if you lose the court case, subsequently you may have to vacate the house. The seller says, no, don't worry at all. We will definitely win the case. You don't need to worry at all. Still then you will say, boss, 1 crore is the market value, but because there is a court case going on, I will deduct, let us say, some 10 lakhs for it, so I will pay only 90 lakhs. Alright. Now in such situation, what has happened? Though the net asset value is 1 crore or the value of asset is 1 crore, we have recognized another liability, though it is contingent, but we are saying here 10 lakhs we will deduct. What is this? This is fair value of the contingent liability that we will identify separately. Right. Then, if there are any intangible assets that the selling company has not recognized, even that we will recognize at fair value. What do I mean by that? So, let us say there is a startup company and they are carrying out a lot of research work. Now, this research, as per Ind AS 38, we don't recognize. Only development expenditure is recognized. But tell me one thing, why am I buying that company? Because that company has carried out a lot of research. I am placing some value on that research work that is done. So this also will be recognized. Though as per Ind AS 38, we cannot recognize, under Ind AS 103, we will recognize. Then sometimes in case of contingent liability, we also get something called as indemnification asset. So what is this indemnification asset? Now here, let us say 10 lakhs is the value of liability we have assumed. Okay, fair value as per us. Now against this contingent liability, what the seller is saying is, see, there is a case going on. If there is loss to you, up to 4 lakhs of loss, I will pay. Beyond that, if there is any loss, you only bear. Okay, now how is that possible? Maybe, we may have to give away some part of the land. Possible, right? So up to 4 lakhs, seller is saying, I will pay. Balance, you bear on your own. This amount is called indemnification asset. Means the seller, the acquiree has agreed to compensate us, so we can recognize indemnification asset separately from the contingent liability. It is something like when we take insurance, we can get insurance claim, something like that. Okay. Now this indemnification asset, maximum amount cannot exceed this liability that we have recognized. So there is a liability. Against that liability, the selling company or the acquiring company has agreed to compensate us up to certain amount, up to the amount that the other company has agreed to compensate us, we will recognize an indemnification asset. But this indemnification asset cannot be more than the contingent liability. Then income tax we will recognize as per Ind AS 12, not at fair value. Apart from this, sometimes you may get Ind AS 105 case also, which talks about non-current asset held for sale, that will be recognized at fair value less cost to sell. Now why are we learning this? We are learning this because all other assets and liabilities will recognize at fair value, but when it comes to income tax expense, we will recognize as per Ind AS 12. Intangibles, though we have not recognized, we will have to recognize under business combination. Contingent liability we will recognize at fair value. Indemnification asset we will recognize separately as an asset. So first thing is, we have seen what is the fair value of identifiable net asset. Second thing, we have to see what is the consideration transferred. We have discussed this already. All of these items are part of consideration transferred. Okay. Sometimes there may be contingent consideration. This will be recorded at fair value. Then, while acquiring another business, there may be some costs which are related to the transaction. So if there are any transaction cost, there are some lawyer fees, registration charges, stamp duty, whatever is there. All these transaction related costs are written off in P&L. They are not treated as a part of purchase consideration. I am repeating once again, if at all the question has, okay, A acquired so much of shares in B and the cost of shares is 1 lakh and they have paid 2000 as broker fees or 2000 as registration charges, any acquisition related cost will be written off to the P&L. We will not consider it for the purpose of purchase consideration. Please note this, don't make the mistake in the examination. Sometimes the company may incorrectly capitalize it. Even then we will have to write it off to P&L. Alright, so that is about transaction cost related to business combination. Then goodwill and bargain purchase, we have already seen how to compute. This is a basic framework of business combination. Now keeping this in the background, we will start solving some basic questions, then we will move to some advanced level questions. Now first one, on 31st March of 21, P Limited acquired Q Limited by issue of 3 lakhs equity shares rupees 10 that were trading at 16 on 31st March. Always remember, we will take identifiable net asset at fair value, purchase consideration also at fair value. Always remember fair value. Yes, there is a different treatment when we talk about common control business combination or common control transaction, that we will understand separately. Alright. The summarized balance sheets of the companies on 31st March before acquisition is given below. Book value of PQ, market value of P and Q. Now what are they saying? P has acquired Q Limited. P has acquired Q Limited. Now generally when 100% is acquired and if Q no longer retain its separate identity, then after the acquisition Q Limited is shut down and only P Limited will continue its accounting. Okay. But whether Q Limited continues on its own or does not continue on its own, initial acquisition accounting remains the same. Okay. Now they have given net assets, book value 80 lakhs, market value, this is what is the fair value, 1 crore 10 lakhs of P and Q. Whom are we accounting? We are accounting in the books of P and Q is being acquired. So market value of Q is relevant. Equity, share capital, other equity. Show acquisition journal entry under Ind AS 103 and summarize balance sheet after business combination. Show the necessary accounting entries in the books of acquiring. So this gives us the hint that acquiry is being wound up and being sold. Okay. This, when sales happen, we prepare something called as realization account. Alright. First, in the books of acquirer, what is the thing we need to do? First we need to see what is the fair value of identifiable net asset. What is the fair value of identifiable net asset? 45 lakhs. 45 lakhs. Then what is the purchase consideration? Purchase consideration, they have said 3 lakh equity shares of 16. So 3 lakhs into 16, 16 3s are 48, 1, 2, 1, 2, 3, 48 lakhs. So I am buying something which has a fair value of 45 lakhs, but I am paying 48 lakhs. 3 lakhs extra I am paying for some invisible item, that is called 3 lakhs of goodwill. So goodwill of 3 lakhs will be recognized. Okay. Now in examination, the thing that you have to keep in mind is any adjustment that you are doing which is not there on the balance sheet should have two-side impact. Okay. First, purchase consideration, is it recorded? No, we have to record it. So this purchase consideration will be recorded. On one side, this purchase consideration will be recorded as equity share capital plus securities premium on one side. So what will come on the other side? We will get net asset on the other side and goodwill on the other side. That's it. Okay. Now first entry, identifiable net asset, always remember at fair value debit. How much, sir? 45 lakhs. 2. Equity share capital. How many shares? 3 lakh shares into 10, that is 30 lakhs. 2. Securities premium, 3 lakh shares into what is the premium amount? 6. See, face value is 10, market value is 16. We are issuing it at 16. So 10 will go to share capital, 6 will go to securities premium, 18 lakhs. Credit is 48 lakhs, debit is 45 lakhs, balancing figure is goodwill, which is 3 lakhs. This is a combined entry. A separate entry if you want to pass, you can pass these two, and instead of this you can say to purchase consideration and subsequently purchase consideration to equity share capital and securities premium. Okay. So you can say asset goodwill to consideration and consideration to share capital. You can pass a combined entry also, that is also acceptable. Okay. Now after combination, what will be the entry? Very, very simple. You will take balance sheet of P Limited as it is and make changes based on market value of P Limited. Market value of Q Limited. Market value of P Limited is not relevant. What do I mean by that? 80 lakhs is the net asset. 80 plus 45. 1 crore 35 lakhs. So now net asset will be 1 crore 35 lakhs. Okay. Then apart from this, we got goodwill, that I will handle it separately. Equity share capital, how much do we have? We have 60 lakhs. How much did we issue now? We issued 3 lakh shares of 10 each. So 60 plus 3, 30, 90 lakhs. 90 lakhs. Other equity, there is a security premium component, 20 lakhs is there plus 18 lakhs. 18 only, no? Yeah, 18 lakhs. 20 plus 18, 38 lakhs. So what I am doing, 80 lakhs plus 45, 135, 60 plus we have issued 30 here plus 18. So 90 plus 38, see, simple mistake, 80 plus 45 is 125. Okay, 90 plus 38 is 128, here we have 125. Where did 3 lakhs go? 3 lakhs will come as goodwill separately and your balance sheet will tally. Okay, so net asset 80 plus 45 plus goodwill and share capital 30 lakhs issued, securities premium 18 lakhs, total equity 1 crore 28 lakhs. Simple and straightforward. They have also asked us entries in the books of selling company. As far as selling company is concerned, a simple principle of realization is that you close all the assets and liabilities account. Okay. Now if I have to close the asset account, what do I need to do? Asset has debit balance. All assets have debit balance generally. I will have to credit them. Now when I say net asset, will net asset have a debit or credit balance? Sir, it will be debit balance. Now I have to credit that account. So I will credit net asset and I will debit realization. So to net asset at book value. What is the book value? Book value of the business is 42 lakhs. So to net asset at what value? 42 lakhs. Okay. Now against this 42 lakhs, what we have transferred, what did we get? We got equity shares. By equity shares in P Limited, we got 48 lakhs. Business is worth 42 lakhs. We have sold it for 48 lakhs. There is a gain. How much is the gain? The gain is 6 lakhs. That will transfer to shareholders account. Now come to shareholders account. shareholders account will transfer equity share capital 25 and 17. Equity share capital 25 lakhs, by other equity 17 lakhs. Then there is a gain of 6 lakhs here. So that also gets transferred by realization account 6 lakhs. 25 plus 17, 32 plus 725 plus 17, 42, 42 plus 6, 48. That will give them equity shares in P, 48 lakhs. This is how the ledgers are prepared. Now always remember, in realization account we transfer only asset and liability, and in shareholders account we transfer whatever is the shareholders fund. First we close the realization account and calculate whatever is the profit or loss. That profit or loss also is transferred to shareholders, because ultimately profit and sale of business belongs to the shareholder. That will be settled by the consideration received from the other party. Alright. So that is how it is done. Now based on this we can pass the journal entries in the books of selling company. First entry, realization to net asset, we saw, we debited realization account, credited net asset. Shares in P to realization, this also we saw. Realization to equity shareholders for transfer of profit. Equity share capital, other equity to shareholders account for the shareholders closure. Then shareholders to shares in P, 48 lakhs. So what I suggest is, first visualize this realization account and shareholders account, then realization to net asset, equity shares to realization. Equity share, other equity to shareholders, shareholders to equity shares in P. Like that we can pass the entries easily. Once you visualize the ledger, passing of journal entries will be much simpler. Okay. Again a quick recap. Net asset you have to transfer, we have to credit net asset, we will debit realization. Second, we received equity shares, so it's an asset for us, we will debit it, we will credit realization. Profit will credit to shareholders. Then we will close share capital and other equity. How will we close? By debiting the respective account, transfer to shareholder. Shareholders will issue the shares and close the account. Now, using same facts and circumstances, if we say that P Limited acquired shares, sir, what is the difference? Here what we are saying, here you are saying P Limited acquired Q Limited, we have issued the shares and Q Limited is being closed down. In the second scenario, what we are saying is P Limited acquired 100% shares of Q Limited. 100% shares, which means Q Limited will continue to be in existence. Q Limited will continue to remain in existence. Basically, what happens in such a scenario? We have P, we have Q. Q has its shareholders, right? What will P do? P will issue its shares to shareholders and Q will be now under P. So now P will have investment in Q. Basically, P has purchased shares from the shareholders of Q by issuing its own shares. Okay. Now what changes? Goodwill calculation does not change. Purchase consideration remains same, net asset remains same, goodwill remains same. In the books of P Limited, there are two entries that will happen. One, in separate financial statement or standalone financial statement, you will have investment in Q 48 lakhs. 2, equity share capital 30 lakhs. 2, securities premium 18 lakhs. Okay, this is one entry that we will pass. But in the consolidated financial statement, investment in Q will not be there. In this place, we will have net assets of Q. What will have? We will have net assets of Q. We are combining both the entities because P controls net assets of Q. We will show it under a single balance sheet. And apart from this, there will be any goodwill which appears on initial recognition. Alright. So instead of this 48 lakhs, what we will have in the consolidated balance sheet? 45 of net asset and 3 of goodwill. So the entry remains same. Net assets, goodwill, equity share capital, securities premium. This entry remains the same. Now in the consolidated balance sheet, what will happen is, again, consolidated balance sheet, what will happen is, again, 80 lakhs is there, we will add 45 lakhs and 3 lakhs of goodwill. Share capital as it is, securities premium, whatever we did in the previous case, same thing happens here. Now in separate financial statement, we will have investment to share capital, securities premium, and in the separate balance sheet, we will have this line item called investment in shares of P Limited. This investment in shares of P Limited is replaced with 45 lakhs of net asset and 3 lakhs of goodwill. Okay. from the subsidiary. What about the share capital and equity of the subsidiary? That whatever is there on the date of acquisition will be knocked off against this investment. So what happens is, investment is 48 lakhs. Okay. On this date, on date of acquisition, what is the equity share capital and what is the other equity? How much is the equity share capital of Q? Equity share capital is 25 lakhs and other equity is 17 lakhs. 25 and 17. 25 lakhs and 17 lakhs on the date of acquisition. On the date of acquisition, 25 lakhs and 17 lakhs. Total, if I say, it is 42 lakhs. For something worth 42 lakhs, how much have we invested? 48 lakhs. So how much is goodwill? Don't jump into the conclusion and say 6 lakhs is goodwill. 6 lakhs is not goodwill because this is book value. The fair value of net assets is higher by 3 lakhs. So we will say fair value adjustment 3 lakhs. So fair value of identifiable net asset is 45 lakhs. For 45 lakhs we have paid 48 lakhs. So 3 lakhs becomes our goodwill. So basically what happens, this investment amount gets knocked off against equity share capital, other equity and fair value adjustment on the date of acquisition. Okay. On the date of acquisition, and subsequently we will incorporate the fair value of net asset and goodwill in our consolidated balance sheet. So here once again for you to visualize properly what happens, investment that we have done of 48 lakhs, this we will remove, and equity share capital and other equity on date of acquisition, how much was that? 42 lakhs. That will also be removed. Instead of this, we will put identifiable net asset of the subsidiary. How much was that? 45 lakhs plus 3 lakhs of goodwill. Okay. So 48 lakhs knocked off from here, and when you do 45 plus 3, 48 knocked off from the subsidiary's balance sheet, the total will automatically match. And in the consolidated balance sheet, we will show net asset at 45 lakhs. Alright. So we have seen two basic questions. What happens when there is an acquisition and the subsidiary shuts down, and also when shares are acquired and we continue to do the accounting. Now we will see NCI computation based on proportionate share and fair value. Z Limited acquired 60% interest in P Limited. So controlling interest is 60%, non-controlling interest is 40%. On 1st of January of 2021 for 960 lakhs in cash. Fair value of P Limited asset is 2400 lakhs and liability is 900 lakhs. Z does not wish to report NCI at fair value. NCI, there are two ways: proportionate share in net asset and fair value. Here they are saying they don't want fair value. Okay, what we will do? Proportionate share in net asset. Okay. Now what is the date of acquisition? 1st of January. What is the consideration? 960. Fair value of net asset is 2400. Sorry, fair value of asset is 2400, liability is 900. Okay, so first identifiable net asset at fair value 2400 minus 900, that is equal to 1500. Okay, then second, purchase consideration is 960. Then we have to see NCI at proportionate share in net asset. When I say proportionate share in net asset, whatever is the net asset of that 40%, 40% into 1500, this will be 600. So total is 1560. Owner side 1560, net asset 1500. Owner side 1560, net asset 1500. So we have goodwill of 60. So goodwill of 60 will be recognized. Now how do we pass the entry? First, asset account debit. How much was that? 2400. 2. Liabilities account. How much of liability did they assume? 900. 2. NCI. And this NCI will be shown under equity section in the balance sheet. Okay. NCI is how much? NCI we calculated 600. Okay. Then what is the consideration paid? consideration, they have said cash, right, and it's already maybe accounted for it. So we can say to consideration or to cash. And how much was that? 960. 9 plus 9, 18 plus 6, 24, 24, 60. Balancing figure is goodwill. Goodwill balancing figure, how much? 60. Can we amortize goodwill? No, we cannot amortize goodwill. Goodwill will be shown as an intangible in the consolidated balance sheet and it will be tested for impairment. Okay. So that is how it will be done. Next. On 1st of January, M Limited acquires 80% of P Limited by issue of equity shares, paid up value 100 lakhs, market value 240 lakhs. So 240 lakhs. Identifiable assets are 380 lakhs, liabilities 60 lakhs, NCI at proportionate net asset value. Okay. So what is the net asset at fair value? 380 minus 60, 320. NCI is 20%. 20% of 320, 64. Okay. Then purchase consideration, how much? 240. So what is the total of this? 64 plus 240, 304. Now see, we got net asset of 320, we gave only 304, owner side is only 304, means we got the assets at less than their fair value. Now you may ask, sir, how is it possible that assets are being acquired or a business is acquired at less than fair value in terms of net asset? Sometimes there may be distress sell. Okay. Market value may be higher, but the owner may be in a hurry, right? So when the owner is in a hurry, they may give discount. So here if you see, we got assets of 320, but the owners totally paid only 304. The difference of 16 is called bargain purchase gain and it is credited to capital reserve. Alright. So you will debit the assets, credit the consideration or cash, liability is 60, NCI 64, gain on bargain purchase, under capital reserve, under equity, you will be showing it. Moving on to the next concept where we discuss about step acquisition. Right, I gave you an example earlier, right, where you buy something on 1st of January and then you buy something else on 30th June and this is when you get control. Okay. Now in case of step acquisition, we are paying consideration twice. One here we are paying some consideration and here we are paying another consideration. Now the rule is, on the date of acquiring control, whatever you have paid, for everything you will determine fair value. So basically, maybe here you have paid 1000 rupees, but today the fair value of this 1000 may be 1100. So you will consider 1100 for the purpose of calculating goodwill. We paid 1000, but today the value of that is 1100. Maybe at that point of time share price was 10, today the share price is 11. Because of which the value is 1100. Alright. Now this 1100 is what we will consider for calculation of goodwill. So though investment is recorded at 1000, for the purpose of calculating goodwill, we will take it at 1100. But so then how will the balance sheet tally? The balance sheet will tally because the difference between this 1000 and 1100, whatever is there, that we will recognize as a gain or loss. In this case there is a gain in the P&L or other comprehensive income, depending on how have we classified this under financial instrument. So if we have taken it as fair value through other comprehensive income, we will record it in OCI. If we have classified it as fair value through P&L, we will record it in P&L. So here we are now introducing one more aspect where we are saying not only the consideration transferred on the date of control, any past consideration or past stake or past investment will be measured at fair value on the date of acquisition. Okay, let's look at this question. Entity A acquired 35% of entity B on 1st of April for 35,000. So already paid 35,000. On 31st March of 20, fair value of those shares is 42,000. 7,000 is reported in OCI, means the gain is reported in OCI. On 1st of July of 20, A acquired further 40% stake for 60,000. Net asset of B at fair value is 1,20,000. Previously had 35% shares are valued at 45,000. NCI is at proportionate share in net asset. Now here what we have to do, NCI based on proportionate share in net asset we will compute. For consideration, we will consider not only this 40% stake of 60,000, but also we will say what is this 35% ka fair value, which is 45,000, that will be considered for calculation of goodwill. So what about the fair value difference? That will be recorded in other comprehensive income. Alright. So fair value of identifiable net asset, how much is that? fair value of identifiable net asset is given to be 1,20,000. Second, purchase consideration. Fair value of existing stake 45,000. Sir, where did we get this 45,000? 45,000 is already given to us here. Now, how much of gain will be recognized in OCI because of this? Please remember, 7,000 is already recognized, 42 to 5, 3,000 will be recognized further, okay, because carrying amount is 42,000. Then, how much did we pay currently? Purchase consideration transferred, currently we paid 60,000. This was for 35%, this was for 40%, alright. Then NCI. How much is NCI? 35 plus 40, 75. NCI is 25% of 1,20,000. So 25% of 1,20,000, 120 by 4, 30,000. What is the total? 60 plus 30, 90, 90 plus 40, 130, 1,35,000. The owner side is 1,35,000, net asset acquired is 1,20,000. Why did we pay that 15,000 extra? The goodwill is 15,000. And the difference between 45,000 and 42,000 will be transferred to OCI in this case. Okay. Now, what will be the entry? The entry will be first, identifiable net asset account debit. How much? 1,20,000. Okay. 2, cash 60,000. This 60,000 we have paid for 40% stake. 2, investment in, what is the subsidiary's name? B. To investment in B. Okay. Now, investment in B we have to record at what value? 42,000. This is the carrying amount. Now, there is a gain on this to other comprehensive income, gain 3,000. This is one way. Other way, what you can do is you can increase the value of investment in B by debiting it by 3,000 to other comprehensive income 3,000. This you can do. So, investment in B, in that case, instead of passing 2 entries, you can directly pass a single entry 45,000. Okay. So, if you want investment in B at fair value 45,000, then you have to pass this gain entry separately. Please remember, this gain will not be transferred to P&L if it is classified under other comprehensive income under financial instrument. Okay. So, that is the thing. Then, to investment in B 42,000, to other comprehensive income gain 3,000, or if you do not want to pass these 2 entries, you can pass a single entry of 45,000 investment in B. In that case, you will pass this entry separately for recording the gain. Okay, right? Done. So, cash is done, investment in B is done, OCI is done. 2, non-controlling interest. How much is non-controlling interest? 30,000. 60 plus 40, 1 lakh, 1 lakh 5,000, 1 lakh 35,000. So, we have the balancing figure as goodwill 15,000. So, goodwill will be recorded at 15,000. Okay. Now, if you see the entry again, net asset 120, goodwill 15, consideration 60, it was cash. Previously fair value 45,000 and NCI 30,000, and whatever is the gain of 3,000 will be transferred to other comprehensive income. Okay. Now, with this understanding, subsequently we will take up some questions on business combination where we have to prepare the consolidated balance sheet on the date of acquisition. Now that we have understood the basic steps of business combination, what we will be doing is we will be taking up actual examination questions so that 2 things will happen. Number 1, your confidence will improve that yes, I can handle a 14-mark question. Typically, a 14-mark question which appears in question number 5 that you can handle. That confidence you will get, and also you will see how we can solve or how to approach the questions in the examination. Alright. Now, as I told you earlier, in any examination questions, you will have 2 balance sheets. So, this one is from December 23. Following are the extracts from the balance sheets of 2 companies, Beta and Delta Limited on 31st March. We have Beta, we have Delta. So, Beta has assets, property, plant and equipment, financial assets. 20,000 shares in Beta Limited is held by Delta Limited. So, Delta Limited holds in Beta Limited how many shares? 20,000 shares. Okay. Then you have inventory, financial asset, trade receivables, equity, other equity, current liability. when you are reading the balance sheet, no need to read the amounts in the first go. You just look at the particulars and see if there are any unique items. Beta Limited was to absorb Delta Limited. Now, whenever these kind of statements are seen, one company is absorbing the other company, means entire business is being purchased. Okay, and the existence of Delta Limited will no longer be there. So, assets and liabilities will be acquired and the other company will be closed off on the basis of intrinsic value of shares. Now, sir, what is this intrinsic value of shares? Intrinsic value of shares is nothing but your whatever are the assets, net asset value per share. Net assets value per share means you will take all the assets, you will take all the liabilities, you will do any adjustments that are required, and you will calculate what is the net asset value per share. So, whatever value Beta Limited will acquire Delta Limited will be based on the intrinsic value per share. The purchase consideration was to be discharged in the form of fully paid shares. So, what is Beta Limited giving to Delta Limited shareholders or Delta Limited? Its own shares. A sum of 40,000 is owed by Beta Limited to Delta Limited. What is the meaning? Beta has to pay 40,000 to Delta Limited. Okay, Beta has to pay how much? 20,000. In trade payables you will have 20,000. In trade receivable you will have 20,000. Now, once I have acquired, Beta has to pay Delta. Beta has acquired Delta. After that, will Beta be required to pay anything to Delta? No. So, after acquisition, we will do the adjustment. Then, also included in the stocks of Beta Limited, 60,000 goods supplied by Delta Limited at cost plus 20%. Absorption was completed on 31st March. So, 60,000 was supplied at cost plus 20%. Now, here, included in the stocks of Beta Limited, 60,000 goods supplied by Delta Limited. Okay, in whose stock we have Beta Limited, whatever inventory is there, okay, that has goods worth 60,000 supplied by Delta Limited. Okay, supplied by Delta Limited, and this is still there in the books of Beta Limited. On this, Delta Limited had earned a profit of 20% of cost. Now, sometimes we get confused as to how to do the calculation. Always remember, now what is this? 60,000. 60,000 is the selling price or cost price? Selling price. Selling price is how much? Cost plus 20%. So, 60,000 can I say represents 120? 60,000 is cost plus profit, represents 120. We need to know what is the profit. 20 is the profit. So, total profit earned is 10,000. Now, one thing that we understand as a part of business combination, subsequently as a part of consolidation actually, that whenever there are intercompany transactions and profits, those have to be eliminated. Okay. Now, when we say intercompany transactions or intercompany profits are to be eliminated, that is after acquisition. This is a transaction before acquisition. This is a transaction before acquisition, and as per me, you don't need to adjust this in the books of Beta Limited because it is cost to Beta Limited, and when they had purchased it, Delta Limited was not a subsidiary of Beta Limited. So, the elimination of profit does not arise. But the study materials have taken assumptions, the search transfer also have taken assumption that such profit should also be eliminated, okay, which is technically, if you ask me, is not required because when Beta Limited had acquired Delta Limited, now the elimination is not required because when Beta Limited purchased the goods, Delta Limited was not a subsidiary. It was a normal purchase transaction. It is lying in my inventory at cost only. Okay, that is what should be done. But what is study material or what suggested answer has done, even that I will explain it to you. Now, please remember, the stock is in the books of Beta Limited means stock is not here, stock is here. Okay. Then absorption was completed. You are required to prepare consolidated balance sheet after acquisition, working related to fair value of shares, purchase consideration and number of shares to be issued and the amount of goodwill or bargain purchase. Everything should form part of your answer. Alright. Now, let us zoom out. Who is acquiring whom? Beta is acquiring Delta Limited, the assets and liabilities of Delta Limited. Now, in the assets and liabilities of Delta Limited, there are 20,000 shares of Beta Limited. Beta Limited is not buying back its own share, it is acquiring other assets and liabilities. But this is relevant for us for the purpose of calculating what is the intrinsic value of share. So, if I need to know what is the intrinsic value of Delta Limited, first I need to know what is the intrinsic value of Beta Limited. So, what is the intrinsic value of Beta Limited? So, we can do both intrinsic value. Okay. How do we calculate intrinsic value? You will take the asset. What are the assets? Assets are 10 lakhs plus 2, 12 lakhs plus 3, 15 lakhs. Assets, beta, delta, 15 lakhs. For Delta Limited, 5 lakhs, this investment will consider separately, 5 lakhs, 6 lakhs, 7 lakhs. Then Delta also has investment in beta, value which we don't know, because first we need to derive value of Beta Limited. Based on that we will derive value of Delta Limited. Okay. So this is 15 lakhs less liabilities. What are the liabilities? Liabilities here, if you see, you have liabilities of only 3 lakhs and here you have liabilities of 1,90,000. So here the liability is 3 lakhs. So what is the net asset? Net asset is 12 lakhs. Okay. Net asset of Beta Limited is 12 lakhs. How many shares does Beta Limited have? Beta Limited has 10 lakh shares of 10 each. So 1 lakh shares. Beta Limited has 1 lakh shares. Number of shares, Beta Limited has 1 lakh. So what is the value of share? Intrinsic value per share is 12. How so 12? 12 lakhs divided by 1 lakh, 12. So when I do the valuation of Delta Limited, investment in Beta will be 20,000 into 12, which is 2,40,000. For the purpose of calculating intrinsic value of shares, we will consider investment in Beta, which is 20,000 into 12, 2,40,000. So this makes it 9,40,000, and liability is how much? Liability is 1,90,000. Liability is 1,90,000. So 940 minus 1,90,000. How much do we get? We get 7,50,000. How many shares are there? We have 60,000 shares. So divided by 60, we get 12.5. So in other words, the value of business of Delta Limited is 7,50,000, of Beta Limited is 12 lakhs. Per share valuation comes to 12 and 12.5 lakhs. Now sir, where is this intrinsic value used? The intrinsic value will be used when we determine the purchase consideration of Delta. We will say we will issue shares of Beta, assuming the fair value of the share is 12 per share. Okay, so that is the first thing we need to understand. So intrinsic value is 12 and 12.5. 12 and 12.5. So do we need to write this in detail? If you have time, you can write. Otherwise, you can take total assets also. Okay, depending on the time that you have. So we have computed intrinsic value, and we have also seen what is the value of business, right? Now, just zooming back a little, Beta is acquiring Delta Limited. How Beta is acquiring Delta Limited? By issuing shares. Okay, by issuing shares. Now, when Beta is acquiring Delta Limited's assets by issuing shares, they will acquire PP, okay, financial asset, they have shares in Beta Limited. Now, how will it look that Beta Limited is issuing its own shares to acquire back its own shares? That will not happen, right? So, these shares will exclude from the entire acquisition process, because I will not acquire my own shares by issuing my own shares. So, if I have to acquire this 2 lakh or 2 lakh, that is 2,40,000 of shares, I have to issue my own shares to get back my own shares. So that doesn't look logical. So this part will exclude for the purpose of acquisition. Remaining all assets will be acquired. So when we have to decide how many shares are to be issued, so if we have decided intrinsic value, then we have to see number of shares to be issued. How much will that be? So number of shares when they are issued, we will see what is the value of business, 7,50,000. Total intrinsic value of Delta, 7,50,000, less shares of Beta held by Delta. Shares of Beta held by Delta, that is how much? 2,40,000. So how much will we acquire net? 7,50,000 minus 2,40,000, that is 5,10,000. 5,10,000 worth of shares or business. Now, I am purchasing net assets of 5,10,000, and what am I giving in return? My shares, and my shares have value of how much? 12. So, value per share issued is 12, 10 is face value, 2 is premium. Number of shares is equal to 51 divided by 12, you get 42,500. So, number of shares to be issued is 42,500. Total purchase consideration is 42,500 into 12, 5,10,000. So, if you ask me, the net asset acquired is also 5,10,000, shares issued are also 5,10,000, which means for this transaction there is no goodwill and there is no capital reserve. Alright. So, number of shares to be issued 42,500 we have computed, and the total consideration is 5,10,000. Now, because both are same, net asset acquired and also purchase consideration both are same, there is no goodwill or capital reserve. What about NCI? Because we have acquired 100%, there is no question of NCI as well. Alright. So, this acquisition is done, the calculations are done. Now, we have to prepare the consolidated balance sheet. I will be telling you, because we are doing a revision, how to prepare the consolidated balance sheet, and then we will see how to handle each of the adjustments. Okay. Now, whenever we are preparing consolidated balance sheet, we will take book value of the acquirer and fair value from delta or the acquiree. Okay. Now, here there are no changes in fair values. So, property, plant and equipment will be how much? 10 lakhs plus 5 lakhs, 15 lakhs. 10 plus 5, 15. I will tell you how to present the working and all of that, but understand the logic. Shares in beta, did beta acquire its own shares in beta? That will result in a buyback. This is not acquired, this is cancelled out. Inventory, 2 lakhs plus 1 lakh, inventory is 3 lakhs. Now, here is where I will put a star and explain you the unrealized profit on inventory concept and tell you what is the treatment that the suggested answers have given. Trade receivable, 3 lakhs plus 1 lakh, 4 lakhs. Now, equity share capital, we have 10 lakhs. Equity share capital of the acquirer or the parent is only considered, of the acquiree is not considered. So, we will only take 10 lakhs, we will not take 6 lakhs. But. Here, because we have also issued shares to acquire Delta Limited, that accounting also has to be done. Correct or not? Because the issue of shares is not yet accounted. How many shares did we issue? We issued 42,500 shares. So, 10 lakhs plus 4 lakhs 25,000 if I do, I get how much? 14 lakhs 25,000. That will be the share capital. Okay. Then other equity, 2 lakhs plus 1 lakh 10,000, 3 lakh 10,000 plus securities premium is 2 per share. So, 42 lakhs, 42,500 into 2, we have how much? We have 85,000. So, 2 plus 3, 310 plus 85, 3 lakhs 95,000. That is securities premium. Okay, then current liabilities trade payable, 3 lakhs plus 1 lakh 90,000, 4 lakh 90,000. 4 lakh 90,000. Simple addition of two balance sheet, book value of the acquirer, fair value of the acquiree. Now, coming to adjustments, included in the stocks of Beta Limited, we have 60,000 of goods supplied by Delta at a cost plus 20%. So, generally what happens is, whenever there are intercompany transaction, the profits are eliminated. We will understand this in Ind AS 110. Now, here what is the profit we calculated? We calculated profit of 10,000. Where is this 10,000 setting? This 10,000 is setting in the inventory of 2 lakhs. Okay. Now, if you ask me my opinion, because it is a pre-acquisition transaction, this need not be adjusted. But what the suggested answer has done is that 10,000 of profit, what was earned by Delta Limited, and that sits in the net assets, right, somewhere in the assets of the selling company. It would be there, right, because when the selling company makes profit, it will increase the asset. So, what they have done is that unrealized profit component, we will remove it from inventory. This is done if it is happening post acquisition, no problem on that. But here they are saying, okay, 1 lakh of profit has to be reduced from inventory. Now, if I am reducing an inventory asset, I am reducing the asset called inventory. What should I do next? I should either reduce something on the liability side or equity side, or increase something on the asset side. See, I have said to inventory, how much? 10,000. Now logically what happens, whenever there is an unrealized profit, we debit the P&L, correct, because we have to reverse the profit. Now that P&L portion is actually a part of pre-acquisition profit. The P&L portion is actually a part of pre-acquisition profit or net asset on the date of acquisition, and hence because it is related to net asset on the date of acquisition, basically what I am saying, this profit component I will reduce, which means I will also have to reduce the net asset on the date of acquisition. If I am reducing that net asset on the date of acquisition of the selling company, what will happen? My goodwill will increase. So we have debited goodwill by 10,000. So we will have one more line item called goodwill, which is 10,000, and inventory will actually be 3 lakhs minus 10,000, this will be 2,90,000. I hope it is clear. Second adjustment is a simpler adjustment. They have said a sum of 40,000 is owed by beta to delta. Who has to pay? Beta has to pay. So from beta's trade payable we will reduce 40,000, and from trade receivable we will reduce 40,000. Okay, so you'll have 3,60,000 and 4,50,000. So if you see the consolidated balance sheet, 3,60,000, 40,000 intercompany reduced, goodwill added 10,000 because of unrealized profit in inventory. This is one thing you can remember for the examination. And from trade payable also we have reduced 40,000 intercompany. Otherwise what we have done, simply taken the acquiring company book value, the acquiring company fair value, adding them up and presenting a consolidated balance sheet. Okay. Now here, because it's a simpler question, the treatment of adjustment is not difficult and you can simply add up the balance sheet and get to this answer easily. Alright. Next question, which is from June 24. Here it is about business combination achieved in stages. Means first we have acquired something and then we have acquired further stake. On 1st April of 23, M Limited acquired 30% of the shares of N Limited for 8,000 crores. How much? 30%. Does 30% give me control? No. This comes under significant influence and hence we will account for it as an associate. M Limited accounts for its investment using the equity method of accounting prescribed under Ind AS 28. On 31st March of 24, so this is on 1st of April, 31st March of 24, M Limited accounts for its share of net asset changes in N Limited as per equity method of accounting. Now sir, what is this equity method of accounting? Under equity method of accounting, what we do is investment in associate, or it's also applicable to joint venture. We will take whatever is the cost of investment. To this we will add share of profit and reduce our share of dividend received. Okay, that is how we will do the accounting. Okay. Now this adding share of profit basically is representing what is our net asset change in the associate. So what they have done, they have said they have taken share of profit 700, share of exchange difference in other comprehensive income, this is also like profit, though we don't put it in the income statement, this is also like a profit, and revaluation reserve is also like a profit. So what has happened, they have invested or they have got it for 8,000, 8,000 plus 700 plus 100 plus 50, it is 8,850, it is 8,850. 8,700, 150, 8,850. On 1st April, M Limited acquired further 70% of the ordinary shares of N Limited for cash amounting to 25,000 crores. Okay, so then what did it do? Another 70% was acquired. Earlier we had acquired 30%. Now we are acquiring 70% more, means here we got 100%. The moment it crosses 50%, it becomes a parent subsidiary relationship. Control is established when the stake crosses 50%. Okay. The following additional pieces of information are relevant. Fair value of 30% interest on 1st of April 9,000. Now this earlier what we had got at 8,850 or the carrying amount of 8,850 is now at 9,000. Fair value of identifiable net asset on 1st of April is 30,000. There are 4 questions. Determine the date of acquisition for M Limited. Now as I said, the date of acquisition is the date on which M Limited obtains control over N Limited, and when is the control happening? Control is happening on 1st of April. So the date of acquisition is 1st of April. Then determine the gain on previously held interest in N Limited and suggest the accounting treatment on acquisition as per Ind AS 103. Now whenever we have business combination happening in stages, what happens is First you will take what is the identifiable net asset. Here they have said 30,000. There is no NCI. Okay. Then as far as purchase consideration is concerned, we will see fair value of existing stake. Fair value of existing stake is 9,000 and fair value of consideration that we have transferred. How much we have transferred? 25,000. 25,000. So 25,000 plus 9,000 is 34,000. So we have goodwill of 4,000 that will be recognized. We have goodwill of 4,000 that will be recognized. Alright, goodwill of 4,000 that will be recognized. Okay. Now, before the control actually is acquired or when before the control is obtained, if you look at the consolidated financial statements, you will see investment in associate as on 31st of March of 24 at what value? We bought it at 8,000. We add share of profit and share of profit when we add we got 8,850. This now has a fair value of 9,000 from 8,850 now has a value of 9,000. Okay. So what we do is we remeasure investment on date of control. We remeasure investment on date of control. Okay. So when we remeasure investment on date of control, what has happened? My investment is having a carrying amount of 8,850 and the value of existing stake now we are saying is 9,000. This fair value change or the difference between carrying amount and fair value, this 150 is a gain which is recognized in P&L. And also please understand, when we prepare a consolidated financial statement after control is established, we will remove this investment in associate, correct or not? Because if you see in the consolidation process, the equity of the subsidiary is knocked off against the investment made by the parent. So this 8850 will be knocked off, we have to remove it. Now this 8850 has multiple different components, one cost, second P&L, third OCI component. So the respective components also will be de-recognized. Please understand this carefully, I am telling once again. When we made this 8850, we would have said investment in associate 850 to P&L to OCI. So what went to P&L? 700 went to P&L, 150 went to OCI. 700 went to P&L, 150 went to OCI. First entry will be investment to bank, then we have investment in associate to P&L to OCI. Okay. Now, for me this 850 plus also the 8,000 originally, all of this has to be eliminated. I have to remove that. When I remove that, P&L stays in P&L, OCI also needs to be removed. Now in this OCI there are two components, 100 is one component, 50 is another component. Okay. 100 is one component, 50 is another component. What is this 100? Exchange difference recognized in OCI. Now exchange difference recognized in OCI, when I dispose of the foreign operation, what will I do? This part I will transfer to P&L. Revaluation reserve in OCI. If there is a revaluation reserve, then when I dispose of the property, plant and equipment, will I transfer this revaluation reserve to P&L? This is not allowed. So revaluation reserve will remain in retained earnings. This will be transferred to P&L. Whatever is there in P&L, already there. Earlier recognized in OCI, classified to P&L, and revaluation reserve remains in retained earning. These adjustments also we have to do. Okay. So basically what happens, 150 of P&L because of difference between fair value and carrying amount, and another item of 100 also will be recognized in P&L. Alright. So when we pass the entries, we will incorporate all the identifiable net assets 30,000, no problem. Goodwill we have already computed 4,000, no problem. Cash that we have paid 25,000 currently, no problem. Investment in associate will be de-recognized because now we are incorporating directly the assets of the subsidiary. So that will be de-recognized. Till here you will not have any problem. Then the gain on de-recognition, we computed 150. This also you have understood. Then we have two components, foreign currency translation reserve and PPE revaluation reserve. This PPE revaluation reserve will be transferred to retained earnings, like we do in case we are normally transferring out PPE, and this foreign currency translation reserve will also go to P&L. So 150 plus 100, that is how we have got this P&L of 250. Okay, that is how we will pass the journal entry. Let's look at the next one from June 25, business combination achieved in stages. Tista Limited manufactures and sells car. The company wants to foray into two-wheeler business and therefore acquires 30% in Mahananda. Both of these are reverse in West Bengal. Okay, for 5 lakhs as at 1st of February and an additional 25% stake as on 31st of March for 5 lakhs at its fair value. Okay, so what did they do? They got 30% interest in Mahananda for 5 lakhs on 1st of February, additional 25%. So this is when you have 55% stake. Okay, 55% stake, and this is when the control has been established. The summarized balance sheet of two companies on 31st March of 25 are given below. PPE, they have given investment in Mahananda 10 lakhs. Okay, so investment in Mahananda 10 lakhs, 5 lakhs plus 5 lakhs, 10 lakhs they have accounted for it. Okay, 5 lakhs plus 5 lakhs, 10 lakhs they have accounted for it. They have not, for as far as this statement is concerned, they have not told us what is the fair value of the 25% stake. Let us see for the information. Investment in corporate bonds, trade receivable, cash and cash equivalents, equity capital. Okay. Mahananda Limited sells motorcycles under the brand name Moving Star, which has a fair value of 3,50,000 on 31st March. As this is a self-generated brand, Mahananda has not recognized the brand in its books. Now we know that even though a self-generated brand is not recognized, but when I am doing a business acquisition, when I am acquiring another business, I am paying something for that brand. So this brand of 3,50,000 should be recognized as an intangible asset. For the purpose of acquisition, fair value of the following assets of Mahananda are estimated as under. So this is Mahananda, fair value is given. PPE 7,50,000, investment in corporate bonds 5 lakhs. PPE 7,50,000, investment in corporate bonds 3,50,000. Sorry, investment in corporate bonds 5 lakhs. Okay. Book value of other liabilities represent fair value. Pass the necessary journal effect entries to give the effect of business combination in accordance with Ind AS. Prepare the balance sheet of the business combination. NCI is measured by the entity at fair value. Provide working notes and ignore deferred tax implications. Okay, so small question, a lot of workings have to be done. Now, whenever we have businesses which are acquired or when the acquisition happens in stages, we need to know what is the fair value of the existing stake, that is one thing, and what is the fair value of identifiable net asset. Alright, so have they given us fair value of identifiable net asset separately? No. Okay, they have not given. So when they have not given, we have to see what are the assets: PPE, investment in corporate bonds, trade receivables, and what are the liabilities? Trade payables. Right, so we'll use this information and we'll compute. Alright, so first, fair value of identifiable net asset. So what all do you have? We have PPE of 7,50,000. We have investments of 5 lakhs. Then we have trade receivables of 50,000. Then we have trade payables of 1,50,000. Apart from this, there is also one more thing. They said there is an intangible asset, and that intangible asset is worth how much? 3,50,000. Intangible asset is worth 3,50,000. Please keep in mind, even if the selling company or the acquiree has not recognized, we will recognize that intangible asset because we are paying something for that brand. Okay. Apart from that, is there any other asset or liability? No other. There are no other details. Okay. So what is the net asset? Now, if you do the calculation, 7,50,000 plus 50, 8 lakhs plus 5, 13 lakhs, 16 lakhs 50,000, 16 lakhs 50,000 minus 1,50,000, 15 lakhs is the fair value of identifiable net asset. 15 lakhs is the fair value of identifiable net asset. I hope it is clear, no problem here. Okay. This you can do it differently also. How differently? See, we have share capital and other equity, which is how much? 6,50,000. Plus 3,50,000 of intangible asset not recognized, plus 4 lakhs gain here and 1 lakh gain here. So plus 5 lakhs. This is fair value adjustment. PP and investment. Fair value adjustment means what is the book value versus what is the fair value, how much is the fair value gain. So 650 plus 350, 10 plus 5, 15. This also can be done. But better if you have individual asset and liability information, do it this way. Okay. Second, we need to know what is the purchase consideration. Fair value of existing stake, fair value of new stake, both of these we know. Now, what is the fair value of new stake, or how much did we pay to get the new stake? For 25% we paid 5 lakhs. For 25% we paid 5 lakhs, this is clear. What is the existing stake? Existing stake is 30%. Now, what is the fair value of this existing stake? Sir, they have not given. Okay, if they have not given, can we derive? If 5 lakhs got us 25%, if you got 25% stake in 5 lakhs, how much will be 30%? So, what we can do? We can do a basic cross multiplication, that is 5 lakhs represents 25% and we need for 30%. 5 lakhs represents 25%, we need for 30%. So, 5 divided by 25 into 30 if I do, I get 6 lakhs. So, what is the fair value here? 6 lakhs. This is the second. So, total purchase consideration is 11 lakhs. Okay. Then, third, what is fair value of NCI? Now, how much is NCI? 30 plus 25, 55. NCI is 45%. So, what we can do? If 5 lakhs represents 25%, how much will be 45%? 5 lakhs divided by 25% into 45%, we get 9 lakhs. So, NCI is how much? 9 lakhs. So, 15 lakhs of asset, total is total of 2 and 3. 11 plus 9, we get how much? 20 lakhs. The owner side is 20 lakhs, asset side is 15 lakhs. So, we have goodwill of how much? Goodwill of 5 lakhs. Clear? Okay. So, we have calculated goodwill. What is the question? Question is, pass the journal entries to give the effect of business combination. Now, when we pass the journal entries, what we will do? We will debit PP, we will debit investment in bond, we will debit trade receivable, we will debit intangible asset, we will debit goodwill, we will credit trade payable, and we will de-recognize existing investment, we will recognize the cash paid, and we will recognize NCI, right? So, when we have to pass the entry, how will we pass? Plant and equipment 7,50,000 fair value, investment in bond fair value, trade receivable as per balance sheet, brand 3,50,000, this is an intangible asset, goodwill 5 lakh we have computed. Then we will de-recognize the investment that is given in the Mahananda Limited 10 lakhs. Now, we have de-recognized how much? 10 lakhs. But if you see here in purchase consideration, we have taken 11 lakhs. 10 lakhs is the investment. Current value is how much? 11 lakh. Sir, what is that 1 lakh extra? 5 lakhs became 6 lakhs. So, there is a profit of 1 lakh. This profit of 1 lakh will be transferred to P&L. So, you will credit that to P&L. To P&L, gain on previously held interest. To trade payable 1,50,000. To non-controlling interest 9 lakhs. Alright. Then combination, after combination, how does the balance sheet look like? Very simple. Tista plus Mahananda, Tista book value, Mahananda fair value. 13,50,000 plus 7,50,000, 21 lakhs. Investment in Mahananda goes off. Investment in corporate bonds 5 lakhs. Trade receivables 1,30,000. Cash and cash equivalents 5,20,000. See, one thing. Here 10 lakhs is already recorded, means the investment entry is already passed. So, no need to pass any further investment entry. And goodwill, how much we got goodwill? 5 lakhs. Goodwill is how much? 5 lakhs. Okay. Then coming to equity share capital, this will be knocked off, and other equity on date of acquisition will also be knocked off. So, we will have only 5 lakhs here. We will have only 15 lakhs here. Again, I am repeating, the investment entry is passed. So, no new entry related to cash payment, equity share issue is required. Then we have NCI 9 lakhs. NCI. Long term borrowings 4 lakhs. And trade payables 5 plus 1 6, 7 lakhs. Done, your balance sheet will be ready. 5 lakhs of share capital. Then we missed out this thing, no? Other equity will not be 15 lakhs, other equity will be 16 lakhs. Why 16 lakhs? Because there is an amount we have credited to P&L, gain on previously held interest. So that 1 lakh will be taken to P&L. Then NCI we have taken long term borrowings and trade payables. Now to ensure that we don't miss any item, what we have to see is, we have removed 10 lakhs of investment, correct? Against this 10 lakh of investment, we have removed equity share capital, other equity, okay, that we have done. Then we have, did we bring in the intangible asset called brand? That also is needed, no? Intangible asset 3,50,000, that also needs to be added, okay, I missed to add that. So intangible asset needs to be added. Then 10 lakhs we have considered 11 lakhs, that 1 lakh of gain we have to recognize here. That is also to be done. Then goodwill will come up, 5 lakhs goodwill also we have to recognize. So that is also done. So all your calculations here, whatever you have done as the calculation, like 1 lakh of gain here, goodwill calculation of 5 lakhs here, NCI of 9 lakhs here, have we taken, like for example intangible asset, this is a new item. All of these items, when you take it in the balance sheet has to automatically tally. That should never be a problem, okay. Then moving on, so we did all the calculations and we prepared the balance sheet and it is done. Let's look at the next question. This is December 25. On 1st April 25, Alpha Limited acquired 100% of shares of Beta Limited. The consideration was discharged by issue of equity shares of Alpha. Balance sheets on 31st March of 25 is given. So one day before balance sheet is given. Assets, PP, investment, inventories. Now tell me, will this investment have equity shares of Beta? No, because it is the acquisition is happening on 1st of April, balance sheet is as on 31st of March, okay. Trade receivables, cash and bank. Then equity share capital, other equity, trade payables. Purchase consideration was settled by issuing 80 lakhs equity shares of 10 each, issued at a premium of 2 per share to the shareholders of Beta. So this is a fresh issue and that is not captured here. Please remember that. If it is not captured there and investment is also not captured, we have to account for shares issued and the investment value will be knocked off against the net asset. So what happens is, your investment in Beta to, let us say, equity share capital, to, and this entry we have to pass. Against this investment in Beta, we will take the net asset plus goodwill, okay. Alpha also agreed to pay contingent consideration of 50 lakhs after 2 years. The fair value of the contingent consideration on acquisition date is estimated to be 40 lakhs. Now what we will take? We will take 40 lakhs. Assume for a moment in the same question they told you discount rate is 10%. Till the time fair value is given, you will take fair value only, you will not discount. If fair value is not given, that is when you have to do the discounting. The fair value of Beta Limited assets and liabilities are 950. Inventory is 280, trade receivable 190, 10 is considered doubtful. Now if the fair value, now see they have said fair value is 190, 10 is considered as doubtful. If out of 190, 10 is doubtful, then the fair value should be 180. But if you are saying that fair value itself is 190, then you don't need to remove the doubtful component. Both the assumptions are possible. Depending on which assumption you take, your goodwill or capital reserve calculation will change. Trade payable 500 lakhs, investment is nil. Oh, no fair value for investment. Okay. There were intercompany balances. Alpha Limited has a receivable of 20 lakhs from Beta Limited appearing Alpha's trade receivable. So this will be removed after acquisition. Expense related to issue of shares amounted to 12 lakhs. Okay, fine. First, compute the purchase consideration. Simple. Purchase consideration is 80 lakhs into 12, 10 into 2, right? So purchase consideration, equity shares 80 lakhs into 12, 960 lakhs. Then contingent consideration, how much? 40 lakhs. Total is 1000. Okay. Then compute the net asset of Beta Limited at fair value. Net asset of Beta Limited at fair value. So I am doing it in a rough working, you can bring it down in the fair working. Property, plant and equipment, what is the fair value? 950 lakhs. Investment 0. Inventory, what is the fair value? 280 lakhs. Trade receivable, what is the fair value? Now we can take both 190 also, 180 also. Question is not clear. So we will take 180. Cash in bank, it will always be at 100. Trade payable fair value is 500. Okay. So what is the fair value of net asset? 950 plus 280 plus 180 plus 100 minus 500, fair value is 1010. Sir, if I take instead of 180, if I make this 190, then this will be 1020. That's the difference. Okay. And both the assumptions are considered correct in the suggested answer. Compute the goodwill or gain on bargain purchase. So my purchase consideration is how much? 1000. So net asset is 1010. Means we paid less and got more asset. Means there is a gain. So my gain will be 10 if I assume this, 20 if I assume this. Pass the journal entries in the books of Alpha Limited to record the business combination. Now passing journal entries should be more easy. Okay. Now journal entries in the books of Alpha Limited. First, for the purchase consideration, investment in Beta Limited, to share capital, to securities premium, to contingent consideration. This will be at fair value. Okay. Then this is the first entry when we have invested and issued shares and assumed contingent liability. Then recognize net asset, trade payable, knock off the investment and recognize the capital reserve 20. Okay. Sir, can we combine both these entries? Yes, you can combine both these entries. Sir, why did we not take NCI? Because there is no NCI. So that is why in this there is no NCI that is appearing. Alright. Then after acquisition, we will have to eliminate the intercompany balances of trade payable and share issue expenses to be taken to P&L. Please remember, transaction costs are not considered to be purchase consideration. They have to be transferred to P&L straightforward. Okay. Then after that, you can prepare the combined balance sheet. That will be simple. Alright. So you can see the questions are not very complicated in the examination, some adjustments here and there. If you have a framework, okay, first I need to know what is the identifiable net asset, then what is the consideration transferred, then what is the NCI, how much is the goodwill, then simple addition of two balance sheets, 14 marks in our pocket. Okay, please do practice journal entries, that is also very important.